For decades, Renaissance Technologies' Medallion Fund has represented the mathematical ceiling of quantitative finance. Their legacy models ingest massive streams of historical data, applying hidden Markov models to execute statistical arbitrage across the global order book. This classical methodology reliably extracts profit margins while experiencing historically minimal execution slippage. But as modern global markets scale in complexity, relying on pure time series analysis hits a mathematical wall. The computational architecture underlying these legacy models is reaching an absolute physical limit. Standard quantitative models hunt for signals by separating market data into distinct time series vectors, tracking price movements, analyzing volume metrics, charting order book depth, and macroeconomic indicators. To identify cross-asset correlation across these separate categories, classical models must calculate massive covariance matrices. This creates an intractable bottleneck known as the curse of dimensionality. In a market of n variables, the required state space grows exponentially at a rate of 2 to the power of n. To keep calculations viable before the market moves, standard machine learning systems are forced to compromise. They truncate dimensions, aggregate vital data, or operate on the false assumption that market conditions remain stationary. As a direct business consequence, algorithms constantly leave money on the table. They miss deep, multi-asset correlations that remain buried underneath dimensional noise. One framework for bypassing this computational limit utilizes a geometric approach, Tensor-Network Quantum Gravity, paired with the Predictive Tensor Control Plane. To capture true structural alpha, quantitative funds must abandon discrete time series vectors and mathematically analyze the infinite dimensional market state as a single simultaneous entity. Tensor-Network Quantum Gravity solves the dimensionality crisis by discarding pairwise covariance calculations completely. Instead of matching distinct data lists against each other, the framework compresses the entire global financial order book into a continuous three-dimensional surface, a unified tensor network state. This equation defines the mathematical shift, representing the total state of the market as a global density matrix. Under this model, individual data streams no longer exist. The market is structured as a holistic probability geometry. Because this continuous geometry bypasses discrete calculations, every asset is inherently connected without the crushing computational load. Consider a structural inefficiency in the market, such as a transient pricing mismatch between a derivative traded in Chicago and its underlying asset in London. A classical model registers this event as a simple price divergence. Tensor-Network Quantum Gravity observes the exact same anomaly as a physical topological defect in the market's probability geometry. To quantify this defect, the system uses this equation for quantum relative entropy. It calculates the distance between the expected manifold and the live market observation. When this local gradient spikes, an arbitrage opportunity is mathematically proven to exist. Alpha manifests as a mathematically proven physical deformation in the fundamental structure of the market. Identifying that topological alpha is entirely useless if the trade decays due to network congestion or slippage at the exchange colocation center. Classical algorithmic trading bots blindly rely on standard BGP switch routing, forcing orders through the shortest physical network path, regardless of traffic. The Predictive Tensor Control Plane operates differently. It treats the market's physical infrastructure, microwave towers, fiber lines, and routing switches, as a core execution substrate. Because the tensor network provides a predictive heat map of infrastructural stress, the control plane routes trade execution along an emergent geodesic, the path of least resistance. This guarantees the order arrives with virtually zero slippage, physically outmaneuvering competing algorithms. Actuating trades at this speed introduces severe risk. Quantitative funds traditionally rely on strict value-at-risk stop losses to prevent algorithms from triggering flash crashes. Instead of reactive human-coded stop losses, the system utilizes a champion-challenger framework governed by bounded actuation. If an execution route threatens to warp the local geometry beyond a designated safety threshold, the system physically bounds the actuation at the kernel level to ensure absolute mathematical stability. Integrating probability geometry with physical infrastructure routing creates an execution system designed to bypass the mechanical friction of network decay. This simulation evaluated topological structures tick by tick over a 6.5-hour day. First, the global density matrix captured over 85% of true signal amplitude, bypassing dimensionality curses. Next, predictive routing maintained near-zero slippage during microbursts. Fusing these scales, cumulative profit exponentially higher than classical counterparts. The simulation demonstrates that mapping global order books to continuous probability geometries shifts the performance asymptote previously defined by traditional Markov models. Current time series statistical arbitrage operates entirely on the assumption that market signals are isolated, localized anomalies. Instead, the entire market and its physical network infrastructure must be treated holistically as a single, continuous topological geometry. The architecture requires leveraging tensor networks to compress infinite dimensions and mapping predictive geodesics to guarantee perfect physical execution. By abandoning discrete time series analysis for topological physics, quantitative trading removes its computational bottleneck. Alpha generation is no longer bound by the curse of dimensionality.